How are you building relationships with the bankers? You taking them out? Who's paying? Are you paying? They paying? That's how the bankers pick up the tab.
Yeah, it depends. I mean, we just really just kind of phone calls and working with them. And I think, once they go through a deal process with us and see how we get stuff done, they want to work with us. And that's kind of the thing we want to do, right? We're extremely fair, quick, nimble. But then, as I said in the beginning of the call, another thing is transparent. We'll tell you what our problems are. And that's because, I think sometimes people like to hide problems and, kind of avoid them and then use them as an aha moment at the end. That's not what we want to do. We're legitimately trying to get deals done and create value, knowing that $2 million of enterprise value means a lot more, or $2 million of equity value means a lot more to us than zero.
Welcome to M&A Science, where leading M&A practitioners share lessons learned from their experience. If you're interested in keeping up with the latest from M&A Science, visit mascience.com and subscribe to our free newsletter. Every Monday, we share highlights from our interviews and invitations to events as we build the greatest community of forward-thinking M&A practitioners. Plus, we got like 1,500 pages of content and 6 different business lines to help you build a world-class M&A function. Again, that's mascience.com. Also want to put a special thanks to VRC for providing the office space for me to do my podcast today. They helped me out. If those of you not familiar with VRC, they're a full service independent global valuation firm that focuses exclusively on valuations that offer judgment beyond modeling. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Tyler Rodewald, VP M&A at EIS Holdings. EIS Holdings is one of the largest providers of mission-critical environmental and infrastructure services in the United States, serving a wide variety of public and private end markets. EIS is sponsored by Sun Capital. Today, we're going to talk about how to compete in a competitive M&A market. Tyler, how's it going?
Hey, Kison. Good. How are you, man?
I'm doing well. Thanks for asking. Can we kick things off with a little bit about your background? I saw you're VP now. I feel like the last time I talked to you, you're an associate. So what's new? How'd the background evolve from then?
Yeah, it's been quite a past couple of years. So I started kind of in the M&A world at a boutique private equity firm out of Atlanta called the White Oak Group, where we kind of focus in 2 sectors, environmental services and aerospace and defense. A lot of aerospace and defense within that, a lot of SATCOM work. And had the opportunity to join a nuclear detection radiation company on the corporate development side as a manager called Mirion Technologies. We're serving various clients between the government, education, and then also military applications, as well as medical applications. We help lead the M&A team doing probably between 5 and 8 acquisitions a year, with the end goal of exiting relatively soon. Started there in 2020 and successfully SPAC'd with Goldman Sachs October 2021, which we, $2.6 billion SPAC and global company with about $700 million in revenue and over 2,500 employees. We leveraged Deal Room to go through our diligence there and all the streams we went through on kind of a sell side project there, I guess, from a corporate development perspective. And then after this SPAC, I had the opportunity to come up with EIS Holdings as a VP, where out of strange coincidence, there's been like 3 asbestos abatement roll-ups that have happened since 2018 and really since ever. But at White Oak Group, we did the first, we were on the first front side of that in 2018, and I helped lead that charge when I was there. And so this opportunity came around. It made a lot of sense on where we started the company. Understood the industry, which helped a lot too, and decided it would be a good time to go back and service the private equity world rather than stay in the public world.
That's a pretty diverse background there, my friend. You sort of touched a lot of different types of deal, pretty significant volume of deals. And then you ended up doing the SPAC IPO deal, which I think is a pretty big deal. So impressive.
Yeah, it's been a fun journey. We've seen quite a bit. Everywhere we've been has been kind of a high volume shop.
Well, I want to get into it. How do you effectively compete in an auction process?
Yeah, so I think really our first strategy within the auction process is to create a strong relationship. And there's two relationships you're creating. The first one's obviously going to be with the seller. If you don't have their vote of confidence, it's going to be really tough to. It doesn't matter the value. It'll be tough from a valuation perspective wherever you stand. Obviously, money talks at the end of the day, but it helps when the seller likes you. And so we try to create the relationship with them quickly, but also to get access to the seller, create a relationship with the bankers as well. Making sure we're staying actively engaged with them, especially in a deal we really want. Actively engaged, following up every kind of 2 or 3 days, blistering questions, calling them, and showing them that we're really putting the work in on the front side, and being transparent with them on what we're looking for to get this done, and what we need to come to a valuation that we're going to submit, that both parties, or really all three parties between us, the buyer, the seller, and the investment banker, feel confident that we can close on, because we've done our work on the front side and explained to them what we needed to see, and achieves that.
So big emphasis on relationship building.
Yep.
Is that it? Just build a good relationship with the seller and call it a day?
No, the relationships is definitely one. And as we trickle down from there, I think the other part we like to talk to people about, typically on some of the deals we're seeing, they'll be bouncing between, hey, we're going to be a platform company, or we're going to be an add-on acquisition. And so from there, as we create the relationship with the sellers and the bankers, we get a little bit more leadway sometimes, being able to talk to sellers and some other bankers as well, and try to communicate, hey, here's our strategy, and here's what we think coming on as an add-on makes a lot of sense, right? There's advantages to it. I think a couple of things being there is the portfolio diversification that some of these owners are looking for, especially in the founder-owned businesses. They're not trying to roll their chips over into, they're trying to diversify their investments, is the best way to put this. This is typically their 401k, IRA, whatever you call it, their life savings. And so they're trying to get liquidity out of it, right? And so from a PE perspective, you do get liquidity. However, you are still the 20, 30, 40, $50 million business you are today. The difference coming into an add-on here is you might be $50 million of revenue, but you're 50 million out of $200, $300, $400 million of revenue. So it's a little bit smaller chunk of the pie, and a little bit more diversification to where, hey, if your numbers slip a little bit, the group can pull you up. That's one thing. Another portion, as we kind of talk about add-on versus platform, is the management of the business. As you come on as a platform, there's additional responsibilities, but from reporting to your board and making sure the investment team is happy, to where if you come on and really achieving their objectives, right? Whereas the add-on, again, you're achieving the objectives of the broader company. However, we have a corporate team in place today, right? And so you can absorb within the corporate team. The corporate team leads the integrations. The corporate team can help lead the acquisitions and work with you in tandem, right? We search back to our founder-owned businesses and really try to leverage the relationships to source additional add-on acquisitions. However, we have guys here who can do the work and the legwork to get the deal done. It's another thing off the operator's plate that we can handle, where if they're at the private equity group or as a platform, they have to handle themselves. And that's another thing that they got to drive, right? Besides just driving value within their organic business as it is today.
All right, I'm hearing a couple themes. There's relationship, strategy / vision that you're developing and pitching, and then this landscape of who you're competing with the add-ons versus platform. We're going to talk a lot about relationship. I can already tell. So I'm not worried about that. In terms of the other players or that you're competing against in a competitive process, we have platform plays, right? PE's buying
Mhm.
a company as a platform with the strategy to grow it. Then you have add-ons, where in your situation, PE-backed platform that you are looking to add on businesses to continue growing. And then you got strategics, just large company, likely public, that is you're competing with them. Can we break that down in terms of the strategy vision part and what they tend to sell? Because it sort of becomes ultimately the seller's decision. And obviously price is a big factor. But I'm curious, when we think about distinguishing or competing around the strategy vision part, what are the themes that you see amongst those different types of buyers coming in?
It's a great question. I can tell you about our strategy and vision and kind of how we kind of provide knowledge. We really try to provide that on the front side of it.
Okay. Now I'll play the devil's advocate from the others, because let's pretend we're pitching for the same deal here.
Absolutely. And so our approach on strategy and vision is really one of just being open, right? And so we're going to tell you, we're going to integrate these companies. So we're going to do it. We're going to do an extensive integration. No, we call it kind of integration light. However, there's going to be some change. And so again, from a competitive process, right, it might eliminate us from some people who just don't want to integrate, which is fine. That's not going to fit our strategy and what we're trying to do here, right? And creating value for our shareholders, and what we believe is the way to do that within our company. And so we take that on the front side, as well as we try to define roles and responsibilities on the front side as well. Hey, here's how we see you playing within this. How does it work with you? And discuss compensation on our front side, discuss how do you feel like your company fits within EIS, the typical questions there. And then also understanding, hey, what really makes you happy? Like, what kind of management style would you like to see from us post-closing? And try to pick their brain to get the information that we can use to make sure that our investment thesis is going to be realized. And we can also do the things that we need to do post-closing without anybody getting upset on the backside of stuff. And so just a very transparent process up front, kind of saying, here's how it's going to be, but also making sure they're on the board.
Now, this would be really similar to what the other strategics, like public company, would approach it. Would there be any differences, like time frame wise, when you're doing this as an add-on, as a PE add-on versus a large public company? You have different structures, because for them, they're going to have to get this deal approved probably through a board. It just seems there's so much checks and balances. Mm-hmm. And I'm curious, just trying to get a sense of, again, the players here in a competitive process. Are there things that you have as an advantage towards those companies where you can move faster? Are there any things there where it's quicker for you to get approval, or is it still a similar type of process?
So you pulled it out of my brain. That's one thing that I was also going to mention too, is kind of our size. From a strategic perspective, we're about $150 million in revenue. And so we're still at the spot where we can move quickly and nimbly. We have direct access to our CEO, CFO, as well as our deal team at Sun Capital. And so from a timing perspective, we can move real fast. We've put out LOIs and, within a week. Typically, and we'll try to preempt some of it sometimes, right? As we think about a competitive process, basically once work comes in, it's going to get processed. It's going to get processed quickly. And then on the backside of it, decisions are going to be made quickly, right? There's just a couple phone calls to be made and everybody dials in and gets it done. So from a timing and checks and balances too, like, I think a difference here is that maybe not so much with another strategic on this from this next perspective, but at least from a private equity company, what we can differentiate is the timing from the perspective of us rolling in a $20 or $30 million deal to a platform of $150 million in revenue. isn't, we're not taking as much risk, right? It's a much smaller piece of the pie. If the $20 million goes to 10, we can have some other portion of our business pick that up, ideally, right? Or we're not going to lose as much value within a company as maybe a PE sponsor or platform would if their $20 million business goes to 10, right? That it's cut in half, truly, where our business is still going to continue to grow. And so from a diligence perspective, we will diligence what matters and what we need to get done. However, we can move a little bit quicker without having to get into every single weed and turn over every single stone, just from a risk tolerance perspective being much greater than.
So you kind of get a little bit of a best of both worlds. You sort of are bidding on synergies, which allows you to be pretty aggressive there. But then that PE structure allows you to still move and market focus. Some of these deals are smaller deals that some of the big companies may not pay as much attention to. A different view around risk allocation. What about your PE sponsor? Do they help with any of this stuff at all?
If we need it, we obviously have an approval process. We're not just right. And so if we get a little bit bogged down and whatnot, just from a deal flow perspective, they're happy to help in. They've been fantastic from that perspective. And then also, but even questions that we have within the industry, they're obviously really well connected. This is like their second or third environmental deal. I know they have 2 in the fund right now, and I think they've done one before. If not, they've been evaluating the industry for a while. And so anytime we need industry experts that, quickly on the line, they can typically call people up and help us out a little bit from that perspective. And also provide guidance and other stuff they're seeing. So they've been fantastic from that perspective. And also, I think, again, drives towards our ability to get stuff done quickly. They know what they're looking for. We know what we're looking for. It's between those two parties. There's not a lot of ambiguity into what needs to get done to get a deal closed.
Cool. You got some market intel and some connections when you need it.
Absolutely.
All right. We're going to play you competing on an add-on versus the PE firm doing this as a platform play. And I'm curious because my pitch, right? Our listeners are the ones that are the sellers here in the South. As a PE firm buying a platform, my pitch is around, especially when I can do the growth play, like, hey, whether we buy minority or majority, but there's an opportunity for a second exit. Right. And that's what I'm competing in. We're going to bid it competitively on this, but here that's what our goal is as a PE platform play, is that we are very founder focused. We want to help you grow. We want to align with your vision so you can build a successful business. And we know you still got the legs to keep running with it for a period longer. Hey, we want to map that together so that 4 or 5 years, you have an opportunity to take the upside of the value that we create. It's like a pretty good pitch, right? I've gotten this pitch before. So how do you compete against that when you're looking for the full acquisition and actually do the integration?
Yeah, so I think there's a couple things, that's beneficial for us being private rather than public, right? The first one is kind of the second exit and second bite at the apple. Most of our deals are going to have rollover equity in them. Obviously, there's exceptions to everything. And so we try to keep the founders invested into it, right? But also, we are going to have to exit from Sun at some point. And so when that happens, right, the rollover equity they have is going to be realized and go from there. And we'll typically also try to put in, as a seller, you're still going to get the rollover equity if you want it. And then also we do try to work out some sort of additional incentive plan, whether it's bonus pools, options. Sometimes we'll structure it as rollover equity, and inside that, whatever it is, we still have the opportunity to sell that second bite at the apple.
Okay.
And so the main thing that we're going to focus on is, again, what we kind of talked about earlier. Let's say a $50 million deal, you roll over 20% of it, that $10 million of equity as a platform has no diversification of it as of today. So as a platform, your $10 million equity is that $10 million equity. That's all that's there. Your business goes to zero. That $10 million goes to zero. Within our platform here at EIS as an add-on, your $50 million of revenue might go to zero. However, as I said before, EIS can still grow, right? And so your $10 million still has value of it. So it's a little bit less risky investment as a founder owner, which is typically kind of, it turns into another portion of the retirement plan from the $40 million they just took home. But that's a big sell we're going to play. And then also really focus on, you still get to run your business. You don't have to deal, be in, I think a background of where we come from is more so in the environmental services industry, we have a lot of blue collar guys. We have some white collar guys, but still they're engineers and scientists. And so a lot of them, they don't want to deal with guys out of New York on a day-to-day basis, and their requests, and they don't understand the request demands, or, they have their stigma. Hey, I'm a blue collar guy. I show up with a lunchbox to work. Ready to, and so what we can do and offer to them is, hey, you don't have to deal with those guys. That's for us to be concerned about and stay up at night. You show up, you run your business. We'll integrate it for you. We'll run your strategy for you. All you got to do is sell and have that flow down to the bottom line, and we will help you do that as well.
Nice move. I like it. I was thinking back on the platform play that if I am a big-headed CEO like most of us are, I'd be the one that wants to lead building the platform and saying, yeah, that's what we're going to do. We're going to go do some add-on acquisitions and generate all this value. And I get to be the hot shot and captain the ship. But then I like how you painted that picture of, well, you can go do that, but then you're going to have to own up to the Wall Street folks, and whereas
and it is. I mean, we literally just lost a deal. It's so relevant because we just lost a deal on this premise about 2 months ago that we wanted bad. I mean, we pushed up the price, went after it, did the whole everything we're talking about here, explained it to them, and I think when you're doing the M&A, culture is such a big part of this too. And we're really focused on that and trying to create a partnership, and everybody's aligned on the same page. And so if somebody wants to do that, we're never going to wish them bad will, wish them best of luck to you. Right. And that's just the route they want to go. And so you lose the process. It is what it is. You put the time and resources into it. It kind of sucks, but it's also part of the job. It's just, and so if that is what makes that guy happy, more power to him. Best of luck to you, man. And hopefully down the road we can work together in a joint venture, or, as a prime and a sub on a contract or project, and maybe in 3 to 4 years we link the companies up at that time and double our size. It's one of those things that's really tough to compete against as a strategic, and you tell them the pros and cons and go on with the day.
It sounds like you got these variables for the seller to make a decision around vision, speed, and certainty, sort of the factors in play. I'm curious about your approach in building that, because it seems, even though we have these auction processes and ideas, we make them competitive and objective, but we know they're not unbiased, right? It's like going to war. I mean, it's just like anything sort of goes here. We know that, and I'm curious about. I want to learn these strategies I guess rule one is don't get in the competitive process and go source your own deals. Right.
Yep.
But hey, if you've got the shiny thing that you're really after and I have to do it, it sounds like the number one thing, like the whole takeaway is build a relationship with the seller as best you can. In fact, have a good relationship with a banker so he can help you build that relationship with the seller. Is that pretty much it?
I want them, if they tell us no, I want it to suck. And that's just a very blunt way of putting it. But I mean, that's all I really can say to it is, hey, I got to go tell Tyler and Joe, and Joe's our chief strategy officer. Man, I got to go call Tyler and Joe and say, hey, appreciate all the time, everything you've done, you guys, but we're going with the other group. It still hurts. Always will, right?
Do you dig in there and ask them why?
Yeah, of course. Yeah, absolutely. And it, variety of reasons. But typically, as you say, I want to go be a platform. Or this other person just offered us a little bit more money. If we don't want you, right? If we're kind of on the fence about not on the fence about it, but like just basically tapped out and somebody else offered more money and that's what they want to go after, then okay, fine. That's again, no way we can win. But we will never, I say that. Our goal is to never lose a deal based on relationship, right? Because they like somebody else more. It's one of the other intangibles of money or the platform. Really are the only two I can think of that we might get blown out on that.
Do you think people do that? They'll take the vision over price? I guess it's vision and relationship over price. Maybe to a marginal degree.
Very marginal degree. It's yes. A couple $100,000 on 50 million, something. But if you start getting millions of dollars away, it's again, it's a human being. I mean, I don't know many humans who wouldn't.
What about the relationship? What's your strategy to build those strong relationships that get you in that position to compete well in the auction process?
So I can say this because Joe would say it too. So we're kind of two different individuals within our team. Joe, our chief strategy officer, is a former operator. And I mentioned the blue collar workers earlier. He will get on a phone call, and depending who you are, but he'll get on a phone call and tell you, hey, my name's Joe. I'm just a redneck from Arkansas, which is kind of true. I mean, yeah, he's a redneck and he's from Arkansas, but he also has been educated at Harvard and various classes along the way. So he kind of underplays it a little bit, but his operator kind of redneck mentality with a lot of the guys we're working with does provide a good lead in for some individuals. And then also, I have more of the investment experience on the backside of it. A little bit more white collared. I was raised in Nashville and kind of lived in the South my whole life. So I can get a little bit of an accent going if I need to, but I usually don't break those out on too many calls, but and so I'll take more of the investment approach, a little bit more serious here to protect your capital perspective. I'm the numbers guy. That's what I do in the evaluation. And so between the two of us, we're such kind of on the opposite side of things. One of us will hit it off with the owner and be able to drive that relationship home. It just depends on who it is. And we both, whoever it is, we both get out of each other's way and, hey, you got the relationship on this one, you drive this and you need the help, let me know. And so that's kind of how we, I guess, kind of ham and egg it, if we want to use a term around it, on the relationship. And then just from there, after that initial connection, being highly responsive in working. A lot of people, will ask, hey, why do you do so much why do you do so much work on the front side of these opportunities? And, it's, well, yeah, am I guaranteed to get it? No. However, do I have a lot better chance if we're doing the work on the front side? Yes. And then the other part kind of leads into a little bit of it, is certainty to close.
What does that mean, doing a lot of work on the front side?
I'll dig in. We have that valuation work will be completed prior to sending an LOI 95% of the time. There's obviously those exceptions, but I want to see the monthly financials back for a period of time. Typically, like everybody, we go back to the great financial crisis, 2006, 2007, look at the trends, right? And every business has changed since then. Get that explanation, go through that. Try to get monthly financials for the past 5 years, see the cyclicality trends there. And then also just the financial profile of the business. Then a couple of other items we're really focused on is safety. So in our industry, safety is a really big thing. If your safety record isn't relatively clean, you won't win jobs and you won't win work. That's a big thing for us, and it also affects our pro forma financials. There's a score that the workers' comp company gives you that will affect your premium. And so if you have a higher score, your premium goes up. And try to understand that. And so basically anything that could be related to valuation, I want to do that on the front side before we even send it to LOI, rather than kind of putting in a range or something else, so that hey, the bankers and the sellers, whoever it is we're dealing with, know they've done a significant amount of work. They really understand the business. And when they look us in the eyes and tell us they're going to pay $50 million for this, they're going to pay $50 million. And obviously, again, the worst conversation we can have is going back and saying, hey, listen, we missed this on the front side. So therefore, we're going to reduce this price. It's just not a fun conversation to have. And it happens. Not necessarily missing stuff anymore. It's more so it just wasn't disclosed, right? But we really try to avoid that. We really try to avoid that conversation on the backside of it and just do the work in the front when we're not under exclusivity. And we're still spending resources to get stuff done and understand the business and show that we're engaged.
Sounds like that's part of the presentation, is showing that you've really done the work, that you've done your homework, that you're working hard for the deal.
Yeah, I want to talk to those individuals. If it's an investment banker, at least 2 to 3 times a week, kind of leading up to stuff or leading up to different bid dates, right, between IOI and LOI. I say IOI once a week. I try to talk to them. The LOI, it's 2 to 3 times a week, really pushing hard and making sure they're engaged too and know that I'm here.
Now,
and so that's kind of
you gave an example of building rapport with that seller. Is there ways to leverage that banking relationship so that you can get more opportunities to build rapport with the seller?
Oh, 100%.
I mean, is that a clear thing? Like, you don't know the banker really well, so they sort of, you kind of are there in the third tier of the process, versus the person really well, you've gone, had dinner, drinks and whatnot, and then they sort of give you a little leverage to get you that, first in line type of privilege.
Yeah, and I mean, we have relationships with different bankers now where we're first in line. And I got a call. I actually have a call with one of my buddies this afternoon. I call my buddy now, but he's an investment banker, and he will bring us a deal and say, "Hey, you guys have first crack at it. I think this fits." He knows our strategy. Been in the industry for several years. Was at Montrose beforehand and sold his business to Montrose Environmental, and every deal he comes through, hey, here it is. Here's kind of here's where I need to get to from a valuation perspective. Here's why it fits your business. He pitches it. He's starting to pitch deals to us now solely, and says, I will not take this to a competitive process if you can get here, right? And as long as it kind of meets what we're thinking, all right, perfect, thanks, man. And with those guys, we close deals in 60 days. We know what the SPA looks like. They know what to expect from us from a diligence perspective. And so it's that relationship, right, where we now have a quote buy-side engagement with this investment bank. However, the seller's paying the fees. And And so we're getting to processes like that, right, where we've created the relationship and rapport. But then also, I think, is what you're alluding to, where we don't have that, creating a relationship with the bankers and whatnot does allow us, obviously in every NDA and whatnot that they send over, it's, hey, you're not supposed to talk with the sellers. And they try to keep them guarded a little bit. But when they see the work that we've done and completed and been pushing them so hard and know that we're interested, they've definitely opened the doors up a lot. And not all of them, but, some of them have opened the doors up a lot more generously. Hey, yes, you can talk to management, another call. That's fine. Get your stuff you need. Been able to kind of let us in.
A lot of work. We're going to build relationships all around with the seller, with the banker, but the banker seems key because you got a good relationship there to give you guidance on the valuation. Essentially, you could skip the whole process and work with them on the deal if it's early enough.
Yep.
How are you building relationships with the bankers? You taking them out? Who's paying? Are you paying? They paying? I thought the bankers pick up the tab.
Yeah, it depends. I mean, we just really just kind of phone calls and working with them. And I think, once they go through a deal process with us and see how we get stuff done, they want to work with us. And that's kind of the thing we want to do, right? We're extremely fair, quick, nimble. But then, as I said in the beginning of the call, another thing is transparent. We'll tell you what our problems are. And that's because, I think sometimes people like to hide problems and, kind of avoid them and then use them as an aha moment at the end. That's not what we want to do. We're legitimately trying to get deals done and create value, knowing that $2 million of enterprise value means a lot more, or $2 million of equity value means a lot more to us than zero, right? So here's our problems. Here's how we get this done. You solve these problems together, we'll move on. And so from a relationship perspective, that's just kind of how we handled it, being transparent and honest with the investment bankers and what we're looking for and trying to do. And, we don't really, I guess we'll go out to lunch and keep in contact with them and send them emails, ask them how they're doing, but there's not really much wine and dining. It's more so just our actions in how we treat the deal process.
Anything we're missing that we haven't covered before we move on to another topic here? We talked a lot about rapport, demonstrate you've done your homework. Just thinking of other tactical things to build trust, because when we think of certainty, there's a lot of trust factor that goes with it. Anything around that?
I don't have anything written down.
Speed. Yeah, we can actually go back to the interview outline. We haven't been touching that thing yet. So here you go, Tyler. Yeah, you told me you had family watching, so I want to make sure we trip you up as much as we can.
Yeah, of course.
What are your preliminary diligence questions?
Kind of basic, I guess. We'll go over the financials as we talked about earlier. Any legal matters, potential legal matters, right? So we can set our escrows appropriately, make sure we're not stepping into a bad situation there. The safety matters, understanding union exposure that might be there. These are all kind of industry specific. I guess the union and safety are a lot more industry specific. Okay. Let's see. We'll try to understand their revenue splits. What's it by geography and markets? Who are the major customers? So we can kind of see an overlay of, I think a big strategy inside our business is being a services business and where we stand today. We get much more excited about commercial synergies than cost synergies. Right. And so we do a lot of founder-owned businesses. And so within those founder-owned businesses, the salary that's getting paid to an individual, that $60,000 is $60,000 is taken away from the owner. So every salary he brings on, that is a true salary off his P&L, personal P&L, right? And so when you think about it from that perspective, all these companies run lean. So there's really not much room for cost synergies, right? An example of it is, hey, we can take out an AR collection, an AR collections individual, or better yet, a senior accountant, right? Who does some AR collections, who does some senior accounting, does some reporting, whatever they do, right? But on paper, you might think of it as a senior accountant, and we don't understand everything else behind that wall. And so we really right? we don't factor those in first by any means. And then we'll talk to the owners, and if there is any duplicative stuff we can kind of pick up, we will. But our real thing is understanding the commercial synergies, and that's where we kind of dig into the customers and whatnot, and what's the overselling, what's the cross-selling potentials there, and new markets we can move into between EIS and the target we're going after, and try to quantify those on the front side.
How big of a list is those initial diligence questions?
Like 20.
Okay.
And it's
Not
a
too crazy.
lot of it's like valuation driven. Everything, all those are going to drive valuation.
What's your typical time frame to get to LOI in an auction process?
Auction process is kind of weird, right? Because that's always typically set by the bankers. We'll try to preempt stuff where we can. Obviously, we have relationships, a lot easier to do that. But I typically, when we see a deal and read the sim, I think everybody in the industry, I find this kind of funny. When you read a sim, you basically know if you're going to do the deal or not. I think everybody kind of bounces around and does their stuff, right? But you know if you're going to get something done, barring any major red flags, by reading the sim. And so we can move. I've gotten a data request and had a LOI together in 48 hours before. Typically, though, maybe a week, I guess.
Okay.
But that's just because it more so driven by the other guys. Like, we have the time to take. They said we can't preempt it, and so, all right, well, we'll just kind of hold our stuff in and wait on the backside of it, and try to pull out as much information as we can to make the most competitive offer that we can.
And when we touched on the approval process, because for you, is there a certain deal size that's got to go back up to the PE firm, or what does the approval process look like?
No, all of them go back to the PE firm. Just a collaborative approach of it. It's, those are our shareholders, our investors, and we've seen a lot of stuff, but as a group, we've seen even more stuff, right? When you take the group knowledge when you take the group knowledge approach, and so we send everything up and go through that way. But I put together a quick model. We've got it down to a template now, right? Spits out our returns, pretty simple, and tell them the strategic rationale and why we know we want it. And, I think when I think about the kind of the agenda on this, it drives into the next phase of it. Or one of the questions I think that were asked. We understand our investment thesis and we have a strategy, right? We know what we're trying to do. And so when executing on this worked really well when I was at Mirion. We had our strategy was, or let me say this, Mirion, to give a quick high-level background on it, 30-second background. Historically, Mirion had a lot of exposure to nuclear power plants, did a lot of work inside of those, and which kind of that industrials market, or the market for the nuclear power plants, can kind of be up and down, right? And so the volatility and cyclicality that can tie to it wasn't the most attractive to investors and Wall Street and whatnot. And so, right, we came up with a strategy of, hey, we want to diversify and get at least a third of our revenue inside the medical radiation space, or medical space, right, which kind of boils down to radiation therapy and nuclear medicine. And so we took a laser focused approach, said, these are the deals we're going to do. This is what we want to buy. These are the companies we're going after, and executed on it. Does that say we didn't do anything inside the industrial space within Mirion? No. If there's a great target that came along, there was value for, a value creation story on it, at an attractive multiple, absolutely we went after it. But our main focus was really staying hyper focused on what we're trying to do in our investment thesis of diversifying out our revenue. Well, that's what we have here, right? We're an asbestos abatement company today. People see that as kind of a melting iceberg, as there's only a finite amount of asbestos out there, which kind of true, kind of not. There's a lot more, I think from an operator perspective, I'm not an operator, but I've studied this industry for a while. There's a lot more tail than some people think. Maybe a little bit biased there, but still, that's just what I believe. And so, that being said, when we take stuff to the investment committee, right, we know what we're looking for, know what we're trying to do. And so, it's an easy decision of like, hey, Yeah, of course. It's fits the investment thesis. Go get it done. Or if it's a little bit outside the box, we will get questioned on it, but it's taken care of within a 30-minute phone call, maybe an hour.
Are you able to move faster on those deals that are closer to the strategy as opposed to further from the strategy?
Yeah, yes. Just
Because you
there's a little
probably
bit
just,
less questions.
yeah,
There's
it's
less
like
to answer.
a better, tighter business case. It's sort of
A little
there.
bit tighter, but yeah, and there's the ones within our investment thesis, we know the industry, right? We've already studied the industry. We've done our market research on the front side of it. We know exactly what we're looking for. We know how to speak to the industry. It's the ones that are a little bit outside of it to where we need to do a little bit more market research on the front. We'll have our calls with, the different banks and different consulting firms to gather the industry from there. So it adds like a week or two to the process of like how fast we can move on it.
There's this thing called deal fever. And when we look at some of these non-directly in the strategy deals, how do you keep from deal fever from happening? Or is that just
It all happens. We all get our hands slapped a little bit. I told Joe I can put an investment thesis just around anything. It's the group knowledge. So obviously I've seen a good amount of deals. Joe has seen a decent amount of deals and also significant operator experience. CEO and CFO, same boat, right? And then also once you bring it up to Sun, they've seen, MD's been there for like 20 years and the VP 5 or 6 and whatever, right? So they've seen a bunch of deals. And so when you take the group knowledge and put it together and say, hey, this doesn't really make sense, right? And we all kind of, everybody brings a deal to the table that's a little bit ambitious for whatever reason. And so it's how we kind of avoid deal fever is once everybody gets along to the table, puts the ego aside. And, that's a big thing that we talk about when we get into those meetings, the egos aside, be honest with each other and let's talk to each other as professionals and, do what's right for EIS and our shareholders. And so that's kind of how we avoid it.
It's like you basically got to frame everything very objective and try to keep it as black and white. And it is that. It's like, can we get to the root of this and make sure there's no biases here on doing the deal, that, there's some emotional driver behind this of whatever, getting another one on the belt type of thing.
Yep.
And just being that way. Then it seems like because you have others involved that they're going to be like that anyways, because you don't want a bad deal. I think everybody knows in hindsight, nobody wants to have that on the record.
Oh, 100%. And it's, to do this, you have to be to do M&A, you got to be very check your ego at the door, right? And just be honest with yourself. And we're all type A, maybe type A and at 0.5 at the least individuals, right? A lot of us graduated top of the class, smart, always been outperformers. And so, as you say, we don't want a deal to fail on our plate. And so it's a lot better to maybe have one get turned down that doesn't necessarily fit your strategic vision and strategic value of what you're trying to do, than it is to have something fail. I think that lesson would hurt a lot more.
My biggest lesson from all this is just to avoid the auction process altogether.
Yeah, pretty much. We again at Mirion and here at EIS, we have a very strong push on leveraging internal relationships. Our operators here cold calling too if we need to. I mean, it's trying to avoid the bankers, but they will bring you good deals every now and then. And when they do, we pounce on them and give them our best pitch and put the best foot forward and kind of suck it up for the time being.
Yeah, that sounds like the right way to do it. It sounds like you got a mixed approach. You've got the right opportunity to participate in auction, and then you put the effort in the proprietary deal flow as well. Any balance or anything you've learned over the years that, hey, we should be spending X percentage of our efforts and building out the network? And obviously you can get some of these sort of semi proprietary deals through an advisor. We have that strong enough relationship. And then maybe working directly with a PE firm, if they got something they're thinking to take to market. but is there a certain sort of split that you put between it?
Uh, I guess in a broader sense, maybe 15 to 20% of the time, focus on sourcing. Um, just ebbs and flows a little bit, right? You can get stuff in the pipeline, get real busy, and then you're sitting there about halfway done through the deal, and it's like, oh shoot, I need another one after this. I don't want to get bored. And so I guess 15 to 20% of the time is used to sourcing, whether it's talking to investment bankers, trying to get their minds, cold calling. And then also, as I said, we take a lot of time going through the businesses and talking with our different founder owners there on, hey, who are good targets to go after, who do you know and whatnot. And another team that we like to use a lot too is our sales team. I'm super close with the VP of sales at EIS and having him pitch different targets to us and know what he sees in the market.
What's the split between proactively developing the relationships to the third parties versus like proactively putting effort to source your own deals with or without your in-house resources too?
70-30, probably 70-30 in-house, right?
So 70% on your own in-house and then 30% external?
Yeah, just because, the bankers, like, we know the ones we know, and we really make a good impression once we do start working with them. We're gonna take phone calls, take them out to lunch sometimes a little bit, instead of not much wine and dining. But at the end of the day, two things. Sun has great relationships with those, right? They're a $2.5 billion fund, been around for however many years, like 30 or I think 20 or 30 years at least. I think it's the 90s. And so the other part of this too is we have what the investment bankers want, right? We have money to buy their company. And so they're going to reach out to us regardless. Obviously, it's better if we're viewed favorably so we can, preempt deals and get additional information. However, tons of people are reaching out to sellers and between cold calls and different, in-house relationships that they have. And so that one's a little bit more, you have to be a little bit more proactive in getting those inroads and creating those inroads. Because, in the environmental services space, every single person I talk to has somebody else calling them, and not just one other person, right? It's several. It's a hot industry, a hot space, and so highly competitive. And so I spend a lot more time kind of making sure that those guys see us, right? In the instance they do decide to sell, they think of Tyler and Joe in EIS as a great stomping ground to go to.
I like that 70-30 split. Seems really on point. So makes it lands well with me. I guess we're ready to wrap things up over here, but any other advice in competing in an auction process that you want to share?
I guess it kind of goes out to something my dad taught me, 3 things of living life is doing business or whatever: honest, ethical, and hardworking. If you get those 3 things, you're going to be able to put a really good foot forward and have your company on a pretty good pedestal within the auction process.
Very ironic. It sounds the exact same as advice my dad gave me.
Yeah. Is our dad the same?
Yeah, we got same dad, different brothers,
Yeah.
But, and it takes a while to learn it. It took me a good 10 years to finally learn what he actually meant. But it is true. There's pillars you can't get away from.
No, if you do that in any part of business, right, you're going to be successful. But I think in M&A, it's just such a competitive market, and you're dealing with a lot of dollars, and people are trusting you with their money and their dollars and their livelihoods. And so it's even more heightened to do the right thing.
Tyler, what's the craziest thing you've seen in M&A?
This was a company, this is when I was at Marriott, and by far the best investment I've ever been a part of. And so, we obviously been in the private equity world, numbers, and, we always look at what everybody's getting paid and how people run their businesses, right? And there's a quote, there's not a perfect way to run a business, but inside the industry, there's a quote, perfect way to run a business, right? Pillars that everybody kind of follows along and goes after. So we're looking at this company at Marion, and we ended up, and it's a founder-owned business. And over the past 6 years, they grew the business from $15 million of revenue to 100. And you ask them, hey, how'd you do it? Whatever. The first thing is, hey, yeah, we just, how do you forecast? And he goes like, well, what I did is I basically they were, for reference here, they were putting, they had auxiliary pieces for linear accelerators, which linear accelerators provide radiation therapy for cancer patients. They're the big old machines, and they had add-ons for those. So he goes like, well, I just looked at the market and said, there's 100 linear accelerators out there in the world, which there's more than that, but just for rounding purposes. And I want 10%. I want to be in 10% of those next year. Well, next year I want to be in 15%. Next year I want to be in 20. So, okay. And so that's the first part, right? I was like, I hadn't heard of a interesting way to forecast, see what you're doing, makes sense. And then the other thing is I gave my salespeople fat bonuses. And so he's paying his sales guys $1 to $2 million per year on these bonuses for hitting them, right? And this is on top of commission. So these sales guys were getting $2.5, $3 million a year because they kept hitting the numbers, and it just grew like a weed, right? And they had these throughout the business. So there's a guy that they came in and had this software that they're running on these linear accelerators, and they said, hey, you need to develop this and take it from I forget the word now. When something's on a hard drive compared to the cloud.
On-prem?
Yes. Take this on-prem solution and move this to a SaaS solution, right, in the cloud. And if you do it successfully within 2 years, $4 million bonus, right? And we found this out during the transaction, and because it was in the middle of it, we're buying the company, we're on the hook for the $4 million. At first everybody said, what's this? This is ridiculous. Why is he paying all this money? And we start talking to him, and he goes well, yeah, I don't want to give away my equity. So I just said, I'll just pay people whatever I need to hold my equity and compensate them heavily for value creation, right? Like the sales guys. And so is it a completely crazy knock your socks off story? No. But it's one of those stories that kind of give me a different perspective when evaluating businesses and in compensation for individuals of, well, they say if you pay people, they'll do work, and, good things will come. And it was one of those, just a completely different way of running a business that everybody's kind of staring at for a second, knowing we need to do the acquisition a little bit and take on this risk. But it turned out 6 months after closing, TTM EBITDA had already grown by 20%, and it just kept ticking up. And it, completely blew it out of the water. Best acquisition we've done. And just on a business model that all these deal guys, right, that at Marion we're looking at, at first, this is kind of crazy. And then realizing the backside, this is a very interesting way to run a business that made a bunch of money.
Take care of your people. I like it. You're compensating them on the value they create.
Yeah. And it's, hey, what's a $4 million bonus when you just created $10 million of equity value for me?
Absolutely right. Oh, this has been a great conversation. Thank you for taking the time. You taught me some new things.
Awesome. Well, thank you. Thank you, Kison. Appreciate your time today and reaching out, and happy to do this for you anytime.
Hey, those still with us, I appreciate putting them on a raspy voice. I'm just getting my voice back after losing it. But thank you for taking the time to explore the world of M&A with our podcast. We love hearing feedback. Tag us on LinkedIn, add a review on Apple Podcasts. If you need any help with M&A, I like hearing about some really interesting big corporate M&A challenges, but we got tons of resources on our website. That's mascience.com. You can reach out to me via email, Kison, Kison @mascience.com. And until next time, here's to the deal.